What I'd like to talk about in this video is income taxes and calculation of taxable income. So to do that, I'm going to be talking about how income taxes have been, are, and may be going forward, factoring income taxes into our economic analysis, after-tax rate of return, and the implication of capital gains and losses for non-depreciated assets. So the holy grail of engineering economics is after-tax cash flow. Projects are calculated and evaluated on an after-tax basis. Now, everything we've done to date has been on a before-tax basis. The principles are all going to be the same. We just have to calculate income taxes, and they're treated simply as another expense. So, in 2018, under Trump, the U.S. lowered its maximum income tax rate from 35% to 21%. And what we need to consider is the highest rates, average rates, and marginal rates. And when we're analyzing companies, project for a company, a new project, we want to know the marginal rate. That is the rate on the next amount of income. And comparing the United States with other developed countries, the United States at 21% federal is relatively, I think it's on the high side, but there are many countries with higher tax rates, several countries with lower tax rates. So I said high, it's probably in the medium side when I think about it actually. So the other thing that we need to consider is that there are states in the United States and they don't all have the same income tax rate associated with them. And in fact, California has a high state tax rate. Many states, Nevada, Texas, Florida, have no state income tax rate. But when you factor the two together, that's what you need to consider when you're doing an investment project. And so like investing in a project in California with a 21% federal tax rate and 11, 12% state tax rate, you have approximately 30 to 33% tax rate. Whereas if you're doing the same exact project in the state of Nevada, it would be 21%. Sorry. I think the point from this slide I want to emphasize is that companies shift profits overseas to lower their corporate tax rate. And everything I'm going to talk about here, I want to emphasize, is done legally. So it's legal, but is it ethical? Is it ethical to shift your profits overseas to pay less income taxes in the United States? I mean, fundamentally, corporations work for their shareholders. If their shareholders didn't want that, they would say no. But do the shareholders even know that that's what's going on? So that's some of the ethics involved behind it. I think all shareholders and all decision makers should be fully informed to make a decision when they vote, when they elect their boards of directors and company officers. Now, because we pay as corporations and individuals income taxes, the government is effectively a partner. The government shares in profits and they share in losses. And this is what's really important from the last video, that we have capital expenses that are depreciable, and the investment is recovered through depreciation. So it's recovered over time. And then we have expenditures for non-depreciable assets, land, other assets, things like working capital is non-depreciable. So you don't really recover that investment. And then when we talk about business expenditures, the difference between capital expenditures and operating expenses. And operating expenses are consumables, things that are ordinary and necessary, not long-lived. So labor, cost of labor, materials, things with a life of less than 1 year, and they're charged and taken against income when they occur. So if we talk about taxable income, and this is a very important point here, it's gross income, it's like sales revenue, total income, minus all expenditures except capital, that's these guys up here, minus the depreciation and depletion. So we're going to recover our capital expenses, not in the year they are incurred, but over time through depreciation. And the only thing that's different from that is if we have bonus depreciation, which we discussed in the prior video. So here's an example of taxable income where we have the gross income of $200 a year. We purchase special tooling in year one. We have other expenditures of the same in year 1, 2, and 3. And so our cash flow is no cash flow in years 1, 60 in year 2, and 60 in year 3. Our taxable income, if we're taking straight line depreciation, so we're going to take this over 3 years, straight line, special tooling, be 20 a year. Our taxable income is going to be 40 every year. So notice the difference between the cash flow and the taxable income. They add up to the same amount, but the timing is different. Now recognize if we were using 100% bonus depreciation, this 60 will be expensed in the first year, and the taxable income equals the cash flow. Now, I'm going to talk about corporate income tax rates primarily. And in 2018, under the Trump administration, the tax rates for corporations were changed from a scale of 15% to 39% to a flat 21%. So it made it a lot easier to do tax planning because the taxes were a flat rate. So prior to 2018, if you were a company with this taxable income, so this is not sales revenue, it's taxable income, fundamentally revenue minus expenses. If your marginal rate would have been, I think most companies are probably, most small companies would be in this range right here, 100,000 to 335,000 a year taxable income. They were in a 39% rate. The I guess larger corporations would have been in the 34 to 35% rate, and this was all changed to 21%. So fundamentally what happened was the expectation for earnings increased dramatically and the stock market took off, because the stock market is the stock prices are the expected earnings from a company over time. Because they were going to pay less taxes, the earnings went up, or expected earnings, I'm sorry. Now let's look at an example here. The firm they're going to expand operations in an existing building. They're going to spend $800,000. Sales revenue is $1,025,000. They have $360,000 in expenses, and they get to take 100% bonus depreciation. First question, what is the first year depreciation? Well, they get to take 100% bonus depreciation, so they can write off the full $800,000. What is the first year taxable income? Well, it's gross income minus expenditures minus depreciation. Taxable income is gross income minus all expenditures except capital minus depreciation. Now, recognize that our equipment cost $800,000. That's the same as the depreciation. That's because the 100% bonus depreciation. If they didn't have any bonus depreciation, we would have easily used straight line over a specified life or MACRS depreciation. So our taxable income is $90,000. Our federal income tax, $90,000 times 21%, or $18,900. Okay, this was example 2. Example 3, let's say that the equipment only qualified for 40% bonus depreciation. And it's maker's 7-year property class. What is the first year depreciation and what is the first year taxable income? Okay, so the first year depreciation, they get bonus depreciation of 40% on $800,000 or $320,000. That leaves $480,000 left. So that is $480,000 is going to get the 7-year makers table applied to it. The first percentage out of the 7-year makers table is 14.29%. So they will take the bonus depreciation of $320,000 and then 14.29% on the remainder, or $68,592. So the total depreciation taken in the first year is the sum of the two, or $388,592. Now the first year taxable income, gross income minus operating expenses minus depreciation. Remember, this was $800,000 with 100% bonus depreciation. $500,000 is your taxable income, 21% tax rate, $105,000. Now look at what happened here. With 100% bonus depreciation, your first year's taxes are $18,900. With only 40% bonus depreciation, 7-year asset, it's $105,000. I believe it's $86,000 difference in income taxes. So that's why these different tax plans, the 100% bonus depreciation, that's why it incents business, incents, I-N-C-E-N-T-S, incents businesses to make investment, because they're more likely to do one if they pay less taxes up front. They're more likely to make an investment. Now, when we consider state income taxes, the combined incremental tax rate is the state income taxes that are deductible from federal tax income times 1 minus the state tax rate. And fundamentally, it's about adding them together. So if California's was 11%, it's approximately 32%, 21 plus 11. Now it's primarily 11 plus 21% of 89%, times 89%. So it's a little bit less because a portion of state income taxes are deductible from federal income taxes. This combined rate is the appropriate rate to use when analyzing projects. So if you had a almost 10% tax rate, it amounts to about 2% in income taxes, assuming this full 10% was fully deductible. So if we have a federal tax rate of 21% tax, state tax rate of 67, what is 67? 6.5%. What is the combined federal income tax rate? we would use this formula right here, 6.5% plus 21 minus times 1 minus 6.5. And we know A is wrong because that's the sum of the two. So it's 26.1. So the tax rate we use in a project is the incremental tax rate for the projected change in taxable income. Now this got exceedingly more simple because of the 2018 change in income tax rates. Now this is an extremely important slide to refer to. So what we've been doing up to date is calculating before tax cash flow. If we want to take taxes into account, what we do is we start with before tax cash flow. We subtract depreciation from it. We calculate, that becomes our taxable income. Calculate income taxes on that. After tax cash flow is before tax cash flow minus income taxes. What I need to do in this is we need to do this before tax cash flow, excluding investments. So we want this number, the first bullet point, to be excluding investments in terms of the, calculating your taxable income. The investments get incorporated in this depreciation number. So let's look at a project where we have $25,000 investment, a life of 5 years, 100% bonus depreciation, annual savings of $8,000, and a salvage value of $6,000. Okay, so our before tax cash flow is the $25,000 initial cost, and then we have $8,000 per year, 1 through 5. On top of that, in year 5, we have $6,000 of salvage value. Now, when I show some of my examples, maybe not this week, but next week, I tend to put another column for salvage value rather than include them in the before tax cash flow. It just makes the handling of the taxes a little bit easier to follow. So we start off with our before tax cash flow, excluding depreciation. We subtract off depreciation, and then we calculate taxable income. Now, the full $6,000 is taxable, and that's because we completely depreciated the asset. We completely wrote it off in year 0 or year 1. So that's that's the easy thing to understand. The less intuitive is that you can have negative income taxes. For purposes of this class, we can assume if we have negative taxable income, we can have negative income taxes. Because I'm going to assume that we're an operating company, we have other income that will offset these losses, if you will. So the income tax we're going to receive is $3,570. And then we're going to pay income tax of $1,680 for the regular cash flow of $8,000. And then we're going to pay depreciation recapture tax on this amount because we wrote off $25,000, but we got $6,000 in sales. It had a book value of 0, but we sold it for $6,000. So our after-tax cash flow is before tax cash flow minus taxes. And again, notice that our after-tax cash flow in year 1 is greater than before tax because we can have negative taxes. Now, there is an animal that's out there that you can You can do a tax loss carry forward, and under certain circumstances, you're required to do that. We are engineers, we're not tax accountants. I don't feel like that you need to understand tax loss carry forwards. You just need to understand that they exist, because most of this tax calculation and depreciation calculation is going to be done by your accounting group, and they're going to give you those numbers. You're going to give them the initial cost, annual savings. They're going to massage them, give you a tax vector, depreciation vector, and then you're going to put everything together, come up with an after-tax cash flow. The critical thing here is to notice that your before-tax cash flow is going to be higher than your after-tax cash flow. And it's going to be higher because you're paying income taxes. However, it's not, 20% higher? I mean, if you multiply this by 80%, you certainly aren't going to get 20.3%. And again, after-tax cash flow, after-tax internal rate of return, after-tax present value is the holy grail of economic analysis. We want to analyze everything on an after-tax basis. Okay, same example. We're going to use $25,000 investment, 40% bonus depreciation. 40% bonus depreciation. Now, this differs from the prior one, 100% bonus depreciation, 40% bonus depreciation. Let me take you through the example of how we come up with our cash flows. So if we look at this problem, this is the initial problem right here. And this goes through the after-tax cash flow calculation. If you look at this, it shows that we have a depreciation recapture. That's slightly different. I separated the salvage value and the income. So this layout is slightly different. I'll post this to Canvas. So that's the first example. Second example is we have 40% bonus depreciation. And let's assume 5-year makers, okay? 5-year makers. This is the 5-year makers table. 20% the first year, 32%, 19, etc. This is right off the table from the last presentation. So income, investment income, investment expense, salvage value, income, before tax cash flow, those are all the same. The difference between these two cases is going to come in the depreciation calculation. And so the depreciation calculation is going to be, I do something off to the side. So I shouldn't say off to the side, I'm going to do it down below. But basically what we're going to do is we're going to have 40% bonus depreciation is 0.4 times $25,000. Our regular depreciation is going to be, we're going to have $15,000 left to depreciate. Okay, so that's 60% of 25,000, and I'm multiplying it by the depreciation rates. So this is the depreciation on the $15,000. Total depreciation is the sum of the two. Okay, so the sum of the two is total depreciation. If we total this all up, $24,136. And we paid $25,000 for it. So the book value is the difference between the $25,000 we paid for it and the amount of depreciation we've taken. It's $864. So our taxable gain is $5,136. The taxable gain is the amount that we are selling it for, 6,000 minus the book value. So that's the depreciation recapture. Now I want to caution you, depreciation recapture is a royal pain. You probably won't be doing this in industry unless you work for a relatively small company, but I want you to understand the concept of it. So the reason that I'm splitting out salvage value is for this depreciation calculation to make it easier to follow. And so basically we calculate taxable income. The income taxes are 21%. I think I made that a variable. That's C30, 21%. And the holy grail is the after-tax cash flow. I calculated an after-tax internal rate of return. I could also calculate an after-tax present value. If I assume my present value factor was, interest rate was 15%, 10%, whatever's given, then we would calculate an after-tax present value. Those are the two performance measures. So this table here, this worksheet here, should help you understand the details of the calculations and doing depreciation recapture. Like I said, it's a real pain. So I believe most engineering economics textbooks will lay out the problem the way it's shown in this slide. This is the way the textbook that I recommended lays it out. However, the way that I showed it to you in the Excel spreadsheet I think is a little bit easier to follow. Okay, a couple of examples here. A firm's before tax cash flow is 800,000, depreciation 450,000, combined tax rate 24%. What is the taxable income? 800 minus 450 is 350. Combined tax rate, I'm sorry, tax due is 24% times 350, $84,000. A company's before tax cash flow is 800,000, depreciation is 450. The tax rate is 24% and the taxes are $84,000, just like this example. What is the after-tax cash flow? It's 800,000 minus 84,000. It does not include the depreciation. Depreciation is not part of after-tax cash flow other than it's utilized in determining the amount of taxes that are due. Now there's an animal called investment tax credit, and it's a credit against taxes. It's not a deduction, it's an actual credit. And it's utilized to incent the investment in certain types of industries. For example, it says historic building preservation, developing alternative energy sources. I put solar panels on my roof about 5 or 6 years ago. Let's say they cost $30,000. There was a 30% investment tax credit. I got $9,000 off of my federal income taxes as an investment tax credit associated with that. There were also investment tax credits associated with instant hot water heaters. I believe there's one for new electric cars. I don't have an electric car, but I believe I've read about that. But investment tax credits occur from time to time when the federal government wants to help spur various industries along. The after-tax minimum rate of return is, I think, I would want to talk about that it's not just applying the incremental tax rate to the before tax rate. It's companies are financed by a mix of debt and equity. The after-tax rate of return is a combination of the company's financing mix. That's how it's computed. And interest payments on debt are not tax deductible. Interest payments on debt are tax deductible. Dividends are not tax deductible. So we have to apply our tax rate to the debt component only. So from your perspective, let's take the after-tax minimum rate of return, the after-tax discount rate, after-tax I. It'll be a given. Companies calculate it. And so I'm just showing, the companies calculate it with this method. I'm just showing it so that you know that it's not just a straight shot applying the tax rate to the pre-tax rate. If you have a non-depreciable asset, land, for example, if you sell it for more than you paid for it, it's a capital gain. If you sell it for less than you paid for it, it's a capital loss. And these tend to be taxed at a different rate than ordinary income. So I was saying ordinary income taxes are 21%. I believe it's, depending upon the situation, it's 15% for long-term capital gains and losses. So that is my discussion on after-tax cash flow. Problems and projects are going to be analyzed on an after-tax basis. And you're going to want to analyze your projects using a format something like this. Now, the format that I showed you in the first part, and then you know what, I'll separate these into two different tabs. But I like this one, the second one, better because it actually splits out the depreciation, and you can make this percent bonus depreciation a variable based upon whether it's 100% or 0%. But we always have, it's good to have a depreciation vector, and I want you to remember, not necessarily remember, but refer to this slide here. This is a critical slide right here in terms of computing after-tax cash flows.